Good afternoon and welcome to today's business brokerage webcast presented by SVN Saunders, Ralston, Dantzler. My name is Tyler Davis. I'm a CPA and real estate advisor here with SVN. Joining me today is Larry Montanus, who's an MBA and another advisor in our business brokerage division. Today's webcast is titled An Introduction to Selling Your Business. Today's webcast is going to kind of give a high-level overview of our business brokerage services, what we offer, the things that we look at when evaluating a business, and the different issues that business owners should be aware of and be thinking about as they consider selling their business. We're going to talk about how we go about evaluating the business, coming up with a value, how we would market it confidentially, and also some of the tax consequences involved in selling a business. We'll also at the end provide a few case study examples to give you some real world examples of businesses that we've been involved with that have sold recently, and also do a Q&A at the end. We want this to be interactive and relaxed. So if you have questions as we go through, feel free to go ahead and submit those using the Q&A feature at the bottom of your screen, and we'll answer those at the end. Again, our contact information will be provided at the end as well. So if you have questions at the end of the webcast, feel free to shoot us an email and we'll get back with you. This webcast is going to be recorded and published both on our YouTube page and also at Saunders, Ralston, Dantzler Real Estate on our website on the business brokerage page. So you can come back to it and reference some of the things that we've talked about and also pass it along to people who might be interested in our services. So right now I'm going to turn it over to Larry to introduce himself.
Hi, I'm Larry Montanus. I've been here for 5 or 6 years. I came to this business of real estate as a totally corporate background in my life. I worked for Procter & Gamble for 16 years, most of it in financing and then in operations management for the last few. I was at a citrus company here in Polk County for about 5 years as a COO. It was publicly traded. And then I was with a packaging company in Europe, the largest packaging company there. And that's where I really got into the M&A business. My role was to buy and sell pieces of that company to reposition us in a more value-added product line. So I did millions of dollars worth of mergers and acquisitions, but it doesn't matter how big the number is. It's the same principles to buy and sell a business, small business or a gargantuan one. So that's where I come from.
Thanks, Larry. A little bit about me. Before joining SVN, I worked at PricewaterhouseCoopers in tax for almost 6 years, worked in our financial services tax division, working on a number of M&A deals for life insurance and property and casualty insurance companies, worked on a couple acquisitions, a couple dispositions, and a number of reinsurance agreements for a number of my clients. My background, again, is in financial services, passed the CPA exam 5 or 6 years ago, and now work here at SVN. And so Larry and I have teamed up to kind of work together to provide business brokerage services to people here throughout the state of Florida. The first thing we're going to talk about is kind of the evaluation of the business.
All right. Now, first of all, the value of a business, the beauty is in the eye of the beholder. To the guy who's selling the business, he's basing it can be very emotional, and he's basing it on what he has built over the years, he or she. For the buyer, he's looking at it very objectively. What do I have to pay for this business, and how can I expand it, make it more profitable? And so his point of view is going to be slightly different, which is why it's very important to hire professional advisors who can help take those differing opinions and meld them into something that makes a little bit more objective. The first one that you see there is market value of the assets. And I'm going to go briefly through this. We'll talk maybe in more detail on a couple of these. But what's the condition, the physical condition of the assets? Are they old, are they new, are they run down? Are they technologically new? Are they up with the current state of the art? Do you own them? Are they leased? What part of it? Is the building owned, but the machinery leased? Is the land owned? These are all questions that will come into play. And then when the buyer looks at it, he says, am I going to have to spend a bunch of money to upgrade this business? So that's important. And then the competitive advantage, and there's a couple of them. Your position in the marketplace. If it's a fragmented market, then you need to be somewhat unique to get anybody's attention. On the other hand, if it's a very concentrated market, then you better be standing out in terms of price, location, how easy it is for your customers to do business with you, and your reputation. Do you have patents, franchise agreements? Do you have trademarks and intangibles, things that can make you unique and protect you? The goodwill of your brand name is different than the goodwill of the business, and we'll get into more detail on the goodwill of the business next. But the brand name, is it really something that's worthwhile? Does it mean something? Because if it does, then that's going to add value to your business, your reputation. And when the case study comes up at the end, that'll be a very important part. The diversity and loyalty of your customer bases. Now, this comes from my corporate background, the 80-20 rule. On your customers, 80% of your sales and profits come from only 20% of your customers. That can be an advantage. It means you've got a loyal customer base, and it also means that you've got a chance to expand that base. On the other hand, if it's your product supply chain, your suppliers, if 80% of it comes from just 20% of your suppliers, you're vulnerable. So these are the sort of things that we will look at objectively and help you figure out what to do about it. And the employee profile. This clearly can be one of the most important things there. Is it if you got multiple employees, are they technically very capable are they going to stay with you? Very important to a buyer, depending on the level of technical skills required and the tightness of the marketplace for labor. You need to protect that transition from an owner to an owner can ruin a deal. And so therefore, keeping those employees could be key to the deal. So moving on to what is the business worth in a little more detail. What are the assets of the company worth? We don't suggest that you have to go out and get an appraisal. It may end up that a bank or a loan person will want to do that. But we can provide you with an objective, what they used to be called the business, what a broker's price opinion. We call it just a market evaluation. We can do that.
And those assets, as Larry mentioned, those can be, both real estate, commercial real estate that the business owns, or they can also just be, vans, trucks, things like that, normal machinery. And oftentimes it's not too difficult to get kind of the fair market value of what those, assets are worth, depending on how old they are, the condition of them, things like that.
And the value of the competitive advantage or the intangibles. They buy in a company that's got a bunch of intangible assets, that being mostly your reputation, your brand reputation, your location relative to your competition and your marketplace.
Yeah, and then the other thing is kind of a franchise, right? Like a lot of times, if you own a franchise, that can be more attractive to a buyer than a non-franchise business, because a lot of times with the franchise, you get support from that franchise, and that parent company is there to provide, maybe they provide all the marketing for the business, or they provide a lot of kind of the admin type work. So sometimes a franchise agreement, while it can be difficult to transfer, sometimes you have to get approvals and things like that. It can ultimately be very attractive to a potential buyer in the industry.
And is the value of the business in the physical assets or the intellectual and intangible assets? Again, that's can be very subjective.
Yeah, very subjective and sometimes difficult to value.
Yeah.
A lot of times when we come up with a valuation of a business, in an asset sale, we start out by, looking at both the income that the business earns, but also the physical assets that it owns. What's the value of those physical assets? And generally speaking, people are paying more than what the physical assets sum up to be for the business. And so that excess is kind of categorized as intangible goodwill. It's categorized as the stuff you can't really measure, the stuff you can't see. You can't put your hands on it and touch it, but the value's there. So it's kind of a three-ring approach of looking at evaluation, coming up with evaluation based on income, physical assets, but also, as Larry's discussed, these valuable intangibles. And those can be patents, trademarks, brand reputations, things like that. So when we look at what the business is worth, oftentimes we look at the financials kind of starting out. We look at the balance sheet. That gives us an indication of the assets. We look at the income statement. That gives us an indication of how the business has been performing. And we look at the statement of cash flows to see where the cash has gone. And are there ways that a buyer could come in and save? Is that a value proposition for the buyer? And so one thing that business owners need to be aware of as you're thinking about selling down the road is making sure that your financials are cleaned up, that you're putting a lot of time and effort, energy, and making sure that those are accurate, and making sure that there's not outstanding questions on them, and that if somebody, a third party, were to come in and review them, like a potential buyer, that they would feel comfortable with what they're buying, and that they could get their arms around what those income statements show, because it is critical to the valuation process. And like I mentioned, we'll take multiple different approaches to coming up with a value. We'll try to value it based on an earnings income multiplier. If the company's been very high performing and has kind of figured out how to generate cash, we'll look at it that way. And oftentimes that leads to the highest value for the business. Sometimes businesses haven't quite figured out the income part of it yet, but they might have incredible assets and incredible intangibles. So many tech companies, right, have these patents, they have these ideas, they haven't quite figured out how to make money off it yet. And so the valuation there would be more on, not on an income multiplier approach, but more on what are the value of the assets that somebody could take on. And that would be both physical and intangible assets.
Well, back to the financial statement just for a moment. We kind of saved that to the last there in the last slide. Very important. You're gonna have to provide IRS stuff most of the time. But without insulting anybody out there, we often know that small business owners have a couple sets of books, and be prepared that the new potential owner is especially if he's not familiar with that business, he's getting into a new business, is gonna want to see what are the real books. I mean, is all the automobiles I see on this balance sheet really for business, or any of them your personal business?
Right.
Insurance policies and stuff like that. It's going to be very important that you are absolutely transparent with your company books for a new buyer.
Right.
Be prepared and don't be insulted when asked.
And part of our approach would be to review the income statement, review the financials, and ask you those questions ahead of time.
Yeah.
What are you paying yourself as a business owner? What what expenses or personal expenses on the company books, whether that's for your personal automobile that you use for work, what are things that, we can add back on the income statement to make the income higher for what the buyer would actually be buying. And so that's kind of the ultimate goal here. So the next once we come up with a valuation, once we evaluate the business and really, understand the business, the next step in trying to identify a buyer and find a buyer for your business is marketing the business for sale. And this can be extremely difficult, much different than a traditional real estate transaction, because again, confidentiality is so critical when you're looking at selling a business. And so the confidentiality aspect is not new to Larry or I. Both of us have worked on publicly traded companies, worked for publicly traded companies. And, in those situations, you're not only trying to keep things confidential, but you're legally required to do so. You can't disclose how a company's performing until they disclose it to investors, things like that. And so both Larry and I have a lot of experience with keeping things on the down low and keeping things quiet. There's multiple parties that you would want to not tell that the business is for sale until it's the right time. And the first group is employees, right? Employees can be critical to that transition, but employees also want to know that they have a future at the company. They want to know that they're, valued, and that they're, that they are going to be able to have a career there with the company. And so making sure that they don't find out the wrong way is critical. So, ultimately, when you find a buyer and you've had those discussions with a buyer about employee retention, things like that, then it's probably the right time to tell your employees. But until the right moment, you don't want your employee finding out from their friend or their cousin that the business is for sale and feeling like they've been blindsided by it. So, one of our key approaches is to make sure that your employees don't find out about it.
That means when we visit to look at the place and to talk with you, it'll be after hours. When we put photographs together, it'll be after hours. And then the next group of people, customers and clients.
Yeah.
Customers are, especially like in the 80-20 rule, if some of your key customers find out you're selling it, without hearing it from you. They're wondering why you're selling it, what's going to happen. Are you going to be, is the new owner going to be as good to me as you have been?
Do they need to find other sources for their product?
That's right. And during that transition time, you don't want to lose some key customers. There goes the value. And your competitors, as we'll talk about a little bit later, maybe is you don't ever want them to know in the beginning, because they will use that against you. There's no doubt about it.
They'll target your customers, and they'll see an opportunity to grow
Absolutely,
their market share.
Absolutely.
So the customers can kind of go both ways.
Yes.
Oftentimes we'll get into this. I guess go ahead and talk about it.
Yeah.
One of the things that we'll do on our end is we'll come up with a target market of buyers. So we'll try to identify who the right buyer would be for your property and your business. And it could be a competitor, right? Oftentimes
Absolutely.
competitors want to grow their market share. They want to grow geographically as well. And so sometimes your competitors are the ones who want to buy your business. And, having those discussions and ensuring that they find out at the right time once they've expressed, a desire to expand and aren't going to kind of undercut you and kind of go to your customers or your employees and try to bring them in, just because they see an opportunity is critical. In addition to a competitor, a potential buyer could just be an investor who's looking for some cash flow, looking for kind of a hands-off, passive mailbox money type business if there's good management involved. The other one could be a synergistic.
Well, right there on that one, good management involved. That guy's not going to buy it unless the good management's going to stay.
Right.
So that's why employees are critical.
Right. And then the other type of buyer could be a synergistic buyer. It could be somebody who has a complementary product to yours or a complementary service, and they're looking at you to round out their business model or to vertically integrate. Maybe your business is the missing piece for them to control the supply chain. Things like that will kind of help target those discussions and reach out to those types of buyers before really kind of casting a big net. And that helps us cater our marketing materials, our efforts directly towards what those people would be interested in. Again, we prepare confidential marketing materials. We don't disclose the business name early on. We don't disclose any, detailed financial information or detailed locations that would give away what business it is that's for sale. Everything's very confidential, high level, non-descriptive, until we've had a chance to identify a potential buyer, vet them out, and get them to sign a non-disclosure agreement before we provide any confidential, detailed information to them. So the final thing we're going to talk about today, before we get into the case studies, is what are the tax considerations of selling a business? One thing that Larry and I were just talking about is oftentimes business owners bring their CPA or advisor into the discussion too late. They should be like one of the first calls that you make once you've identified a buyer and once you've received an offer, and even well before that, honestly, just in talking through your unique individual tax situation. In my former career, we were kind of the tax advisors on transactions, and we were one of the first calls that the company made once they even thought about selling a division or a product or a business. They wanted to make sure that they understood the tax implications of the sale, the direction that they should go, the type of transaction that they should enter into. So making sure that your CPA and tax advisor is aware that you're trying to sell the business.
A really important thing is when we're talking to you today, like you're ready to sell your business. You may not be, in which case we still do all these services for you to help you decide if you want to. But regardless, you should always be working with your tax and your CPA to have your business in the proper shape to pass it on to a child, pass it on to a brother, or sell it sometime in the future. But they are very important people on your team.
Right. And the reason to bring those people into once you are ready to sell is that there is a negotiation that goes into purchase price allocation, of the allocation of the purchase price to specific assets, and understanding the tax implications of the sale of those assets can either effectively increase the price that's paid or reduce your effective price as a buyer that you're actually paying in reality once you consider taxes. So having those discussions are critical. The first step in kind of thinking about the tax implications of a sale is understanding what's actually being sold. Is it the assets of the business? Is it just an asset deal, an asset sale? Or are you selling the legal entity itself? Are you selling the LLC membership interests? Are you selling the common stock of the company? Understanding the structure of the deal is the first critical step to understanding the tax implications and thinking about where you can save on the structure of this deal. Generally, in our marketplace, most small businesses are asset sales. Generally, there's a few reasons why you wouldn't want to do that. For example, if a business has a liquor license that's non-transferable, has to stay with the entity itself, the legal entity, then maybe there's a reason to do a legal transaction that way. Or government contracts, certain contracts like that are non-transferable. There would be a reason to actually go in and buy the interests of the ownership entity of the business. Yeah, and so getting back to the asset sale, generally buyers want to do asset transactions, and the reason for that is that they can pick and choose the assets that they're buying. They don't have to buy all the assets, and they don't have to take on any of the outstanding liabilities or lawsuits or issues that come along with a legal entity.
Yeah, we had that in my corporate world. We bought a company, in the process of buying a company, and found out that they were being sued by one of their previous partners. We negotiated with that previous partner to help reduce that number, but we also reduced what we paid because of that. And then in my most recent one, we had the owner had outstanding notes to previous ownership partners, and we made sure that that was off the books. So these very important considerations.
Right, because of the liability aspect of a stock deal, most buyers, like we mentioned, prefer to buy assets. They're also sometimes willing to pay more in an asset deal than a stock deal because they're not inheriting any liabilities. So if they're inheriting liabilities, oftentimes they'll undercut the price by the amount of liabilities that they're taking on. So once you've kind of decided on doing an asset transaction, an asset sale, there's a purchase price allocation that's done. And this has to be agreed to by the buyer and the seller. And the reason that this is done is for tax purposes, to essentially assign the total purchase price of the assets that are being sold to those classes of assets. So oftentimes, you're selling a business for $1 million. There might be 200,000 of that is assigned to inventory, 300,000 is assigned to the real estate that comes along with it. The extra 500,000 is assigned to goodwill or these intangibles, right? So negotiating the allocation is a real important and critical aspect of an asset transaction because, the seller, for example, wants more of the purchase price allocated to capital assets, such as goodwill, and less allocation to items that would be treated as ordinary income, such as inventory, right? You sell a capital asset, you generate capital gain income, which is taxed at a lower rate versus ordinary income. However, the buyer sometimes wants the opposite. Sometimes they want more allocation of the purchase price to items that are subject to accelerated depreciation and have shorter asset life cycles for tax purposes. And the reason for that is under the new tax reform bill, you can write assets off faster than ever. So for a buyer, if you can allocate and assign more of the purchase price to those assets, you can essentially get a tax deduction faster and in a higher amount to reduce or eliminate maybe the taxes that the buyer would pay on the income of the business over the first 10 to 15 years.
You as a seller should, having listened to that and heard talk a little bit earlier about CPAs, you need to get into that discussion with your CPA before you even get a contract so that you're going in position, that you're not surprised by what the buyer wants to do, that you've got answers and you're ready to go. Again, your CPA, tax advisor, very important.
Right, and this is a negotiation again, and this is one of the big areas to save on the total business sale is kind of in this purchase price allocation tax issue area. The last area where you can really save some money within a business sale is, are any of your assets that you sell eligible for a Section 1031 exchange? And if you're not familiar, Internal Revenue Code Section 1031 allows real estate investors, including business owners who sell a piece of real estate, commercial real estate, to reinvest the proceeds, and you can defer taxes on that sale. So if you sell an asset for $1 million, you don't have to pay tax on that $1 million if you reinvest that $1 million in a replacement property. And so oftentimes in a business sale transaction, there's a lot of real estate that's involved. If the business owns real estate, or if the owner owns real estate as well, they're eligible. So having that discussion with both your CPA and also with your business broker, your real estate advisor, such as us, that's another area where you can really save money in the business brokerage area.
Makes your net sale proceeds much nicer.
So kind of talking through a case study, kind of at high level. One I'm going to talk about, and Larry's going to talk about another one. The first one is a local pest control company, and we're actually hoping to close next week, so I don't want to disclose too much information about it. I don't want to jinx it, but it was on the market for about 6 months. It's a franchise situation, which again, it was very attractive on the marketplace because it did have the franchise support. And the franchise took a lot of the admin marketing type work away from the owner of it. So that's very attractive on the market. And the buyer is ultimately going to be another franchise owner in a different territory, same franchise, but in a different area who's looking to expand. Our marketing materials, again, without disclosing much information, we titled all of our marketing materials online, Central Florida Pest Control Business for Sale. So it kind of gives you enough information without disclosing too much information. So now Larry's going to talk about a sale that he was involved with last year.
We just closed on it, I believe it was December, and it was a local Winter Haven-based auto repair business. Had been in business for over 30 years with the same owner, and he exhibited several of the things we've talked about here today. His reputation was stellar. He had multi-generational customer list. He was also in that kind of a marketplace where he had 2 national competitors right around the corner, literally around the corner from him. So his reputation, the fact that people like to deal with a personal person as opposed to a corporate, monolith, was very important in this particular sale. He's also his own business. He loved it. It was his baby. And he had pretty high opinion of what it was worth when we met with him. We talked him down a little bit closer to what our opinion was, and then we went about marketing it. And we did it, as Tyler was saying earlier, you should not have been able to identify it from any of our materials. We targeted our advertising to like the business websites, business buy-sell type websites, looked through the automobile repair trade organizations. So we targeted as much as possible. Didn't have, actually, ironically, the first real interest was from someone who had just sold a similar business in the same market, and we couldn't keep it confidential. He knew already who it was, but and he had a certain value which is even lower than ours, and that didn't work. But his reputation was key. We had a visit after hours. We took pictures of the interior to put into our display to show the equipment. We visited when we brought in potential buyers. They were, again, on a Saturday or after hours, which reminds me of something I'll bring up. Where was the value? The value, we had all the CPA was involved from day one. I sat down with him myself and went through the numbers so we understood. And then the next thing was that the guy wanted to sell it for such a high price that we were worried about, would we, get that sort of thing. But so we really stressed with people the ability to improve that business. Not that he was doing a bad job. We had to be careful about saying that. But he would not open past 5 o'clock, and he was only open 5 days a week. And he would not do tires, only automotive repair. And so both potential real buyers, including the final buyer, all wanted to be open on Saturdays, all wanted to stay open an hour later, and both of them wanted to put tires in the business, all of which gave them extra income with very little extra CapEx to get into those businesses. So the sale was turned out, everybody was happy. The owner went into happy retirement with a fairly good paycheck. There was some discussion about allocation, and that was settled pretty easily. The buyer, interestingly, was actually a Canadian citizen who came in and wanted to come to Florida because this was a business, and he was in that business, so he knew the business. So that helped us very much. Good deal. Everybody's happy, especially when we cashed our check.
All right, now we're going to move into a Q&A section, and we already have one question that's been submitted. It's directed towards you, Larry. What was the most difficult acquisition you were involved with?
Well, I don't know how much time we have, but the most difficult one was we were a French-based company, packaging industry, largest packaging company in Europe, and a competitor who had a part of his product line which we didn't have, a high-end quality plastic closures. And he came to us and said, we're looking to sell. I made an offer, and of course they refused it. What made it difficult was the structure of the ownership, and the various interests were different. The majority owners were 17 Kuwaitis. This business was in Germany, by the way. Their headquarters was. They had worldwide plants. And they had 17 Kuwaitis. There were 3 persons of the management team, the grandson of the founder, a brilliant German engineer. His accountant, who just wanted to retire. The brilliant German, he wanted to stay on. He actually wanted to be with us because of our reputation in the industry. And the third guy was a young American who wanted to do an IPO and take it public and make him the president. So satisfying those 3 groups was interesting. We had a couple of Swiss bankers representing the Kuwaitis, and they hadn't done a very good job recently on some of the things that they invested for these Kuwaitis, which is why the Kuwaitis were unwinding this one. And so they were really trying to put arm wrestling us to a high price. It was ridiculous. We ended up selling with the price we wanted. It was a good deal. The American went away not so happy, but the one guy went into retirement. And the hardest thing to negotiate, though, even after the price, were the 2 employment contracts to keep the American running the American business and part of the other business, and to keep the German scientist, because he was going to be valuable to us. So it was different people, different backgrounds, different nationalities, different reasons for selling, and what they wanted out of the deal. It worked out well. And even today, it's one of the better parts of that corporation.
Yeah. Handling situations like that with different cultural backgrounds, cultural business.
It was fun.
Acumen, traditions can be very difficult.
Late nights, but fun.
What are the pros and cons to keeping and selling the real estate with the business? That's a great question, and one that every business owner should think about. Sometimes, oftentimes I should say, there's the ability to, for the business owner to, if the business owner personally owns the real estate associated with that, they can hold on to the real estate and enter into a lease agreement with the buyer of the business. They can then kind of create a property, a cash flow for them, into retirement. That's another great avenue to create some long-term income for the person selling the business, is that they can hold on to the real estate, keep the business itself there by entering into a lease with the buyer. And if the buyer doesn't want to buy the real estate because, whether it's liquidity issues or they want to relocate after 5 years, that at least gives them kind of that transition time. The other option is, again, as we mentioned, is to go ahead and sell the real estate and do a 1031 to buy something that they want. If they do want to sell the real estate and the buyer wants to buy it. So that's definitely a good consideration. And again, each situation is unique. Each business owner has a unique income situation and tax situation. And, there's a number of factors at play, but it's definitely something to discuss and to consider.
There are a lot of things that to consider, and funny little things, like the owner of the auto repair business. One of the things he asked for, he wasn't going to kill the deal, but permission to come up there every once in a while and work on his car. He had some old restored cars, which are spectacular. And of course, the new owner said, sure, come on, anytime. He'd like to see him around for his customer base, actually.
One of the next questions is, what is the most challenging part of evaluating any business? What documentation makes the business easier to evaluate and ultimately may increase the value of the business? I think there's a couple different ways to look at this. One, on the financial statement side, oftentimes it's getting comfortable with the numbers for a potential buyer, to evaluate those numbers and to get comfortable with them. That can be really challenging. One best practice is to potentially get an audited or reviewed financial statement that somebody, you bring in a third party, your CPA, an independent CPA firm, to come in and take a look at the books and either perform just a basic review of it or a full-blown audit, depending on your size and scope of your business. And oftentimes that can be required for bank loans, business loans. So if you've had some of those entered into in recent years, oftentimes that helps the buyer get comfortable just because they know somebody else has looked at it and tested a lot of these numbers and really gotten comfortable.
And a difficult part, not really from an analysis point of view, but for us as the advisors, is to recognize the emotional part of the seller's opinion of price. The last thing you want to do is insult the guy and lose the business, but you also do not want to say, okay, if that's what you want, that's what we'll market it at, and then sit out there in the market for a year and fail. You've got to be realistic, but you got to kind of reel him in, or her. We got to remember, we always say he or her, doesn't you? But we got to be able to, slowly get to where you think you're right, and he may be more right than you think because he knows the business.
Right. And that's the big challenge is getting in there and understanding the business, getting your hands dirty, kind of walking through the process, walking through everything that goes into their product or service for us. And really to value a business correctly, that's something you have to do. And that's something that we're committed to doing on all of our projects.
Absolutely. Good point. Excellent.
So I haven't seen any other questions come in yet. But in conclusion, this webcast, again, is going to be recorded and posted on both our SVN Saunders Ralston Dantzler YouTube page and also at svnsaunders.com under the commercial business brokerage page. This will be posted there along with a number of ongoing recurring blog posts that Larry and I have both written, kind of articulating a lot of the things we talked about today in much more detail. But this is, again, something that our company started recently. This is a new division for us, and we're looking at growing it and excited about growing it. We think that this is a great time to buy a business, both because of interest rates where they're at, the ability to get funding, capital, SBA loans, things like that make buying a business more attractive than ever.
My phone number up there is an area code from outside of here, but I am here. It's an old cell phone number.
Larry's based in Winter Haven, and I'm based here in Lakeland. So between the two of us, we can cover all of Central Florida and
we'll go anywhere.
All over the state.
We'll go anywhere.
This is our contact information. Again, if you have questions moving forward, feel free to share the webcast with anyone you think would be interested in our services. And we look forward to hearing from you soon. And we hope you have a great rest of your day.
Yeah, we hope you call us. We'd love to get involved. And it's really, can be a tedious process, but it's a fun process. And we'd enjoy it.
Absolutely. Thanks, everyone. We
Good
appreciate
day.
it.
That mute.